So the title of this talk is Libor Replacement and What That Might Mean for Borrowing. And the questions I'm supposed to be addressing are, could this be the start of a completely new vision for how banks lend to each other or to companies, and everything else is changing in finance, so why not this? The short answers, in case anybody wants to shoot off, is everything else is changing in finance, so why not this? It indeed is. It will be discontinued in 2021. Could this be the start of a completely new vision for how banks lend to each other? Well, the main problem behind Libor at the moment, which we'll dig more into, is that banks really aren't lending to each other very much in some of the currencies and maturities for Libor. So yes, this will also change that. So to get more into what we're doing, Libor is the answer to a very simple question, as I see a lot of bank tags here, so I see everybody knows. At what rate could you borrow funds were you to do so by asking for and then accepting interbank offers in a reasonable market size just prior to 11 a.m.? So a group of banks every day is asked this question, they make submissions, the average is taken, and then that's published at 11:30. Going back into Libor's history, though, it stretches back about 48 years. The first loan that was made on a floating rate was in 1969. Now, this was to the Iranian central bank, which approached manufacturers Hanover Trust. And a Greek banker there, Minos Zambanakis, had to assess the problem of how to get 80 million lent to a fairly cash-strapped Shah of Iran. At this point, he already knew they didn't have really any foreign currency reserves to cover the amount, so there was no way that one bank was going to take that level of risk on. At this point, syndicated loans were not really a very big thing in the market, so it was already quite an innovative idea to get 5 different banks in to try and split up the loan and all take on their level of risk. But then the problem became, how do they assess their cost of funding? How do they agree on a cost of funding? Because they don't just want to charge, well, at that point interest rates were around 8% in London. They don't just want to charge a fixed rate and take on that level of risk. So we come up with a procedure. At the start of each interest period, every bank will submit their cost of funding, will take the average, and that's going to be the floating rate of the loan for that period. It works. Central Bank of Iran is bailed out, and people notice, essentially. This gets picked up in the market. This way of doing things becomes quite common, of syndicates sort of agreeing on a floating rate for a loan at the start of each period, and it becomes known as the London Interbank Offered Rate. Now, the market starts to expand throughout the 70s and into the early 80s, and by 1984, we're at the point where people are quite uncomfortable with this. We have quite a large loan market relying on what is a fairly shabby procedure for setting interest rates. So a number of banks in London approach the British Banking Association. They say, can you consult on this? Can you formalise it? And committees start to meet. And in 1986, we first get BBA Libor, which is the Libor we know today. Every day, the BBA will ask the question of, at that point, 12, expanding to 16, a big group of banks anyway, what is your cost of funds for this period, for this currency? We'll take off the 4 highest, we'll take off the 4 lowest, we'll average the rest. That's going to be Libor for the day. And in the ensuing sort of 31 years, Libor just basically doesn't change very much. Now, I say it doesn't change very much, that's obviously not true. Libor very quickly becomes the way people do loans. Then economists pick up on it, and it becomes the way people do this risk-free rate, and then it becomes the way people do derivatives, and then it becomes the way people do pretty much everything, basically. So by 2016, Libor is now underpinning a global market with a notional value of about $350 trillion. So that represents a 4 million-fold expansion from what it was at the very start of it, and yet a procedure that hasn't changed at all. So even before anything has happened, we have this situation where Libor is clearly unsatisfactory for some of the things it's doing. Nobody ever thought there would be that much money on the table. And indeed, talking to committee members from 1984, from the BBA's setting organisation, not one person involved in this ever envisaged a market situation like this. So we've got good reasons for Libor to go. Obviously, over the past few years, we've got even better ones. In 2012, people who don't work in finance started to hear about it, and they didn't hear about it as an interest rate. They heard about it as a byword for, well, basically corruption and excess and all of the worst things that everybody assumes about those of us who work in finance. We have this scandal where many of the main banks submitting Libor, it turns out, have been colluding in a way that one might imagine they would be tempted to. They are, on the one hand, submitting estimates for what Libor should be for the day. On the other hand, they have a trading department who can make 5, 10 million a day based on a 1 basis point movement of Libor. Do people resist this temptation? Obviously not. They start to build a big ring. Tom Hayes was convicted of being at the head of it, and people collude on the setting of Libor. Borrowers are no longer being charged what is deemed to be a fair rate of banks' funding costs. At this point in 2015, Tom Hayes is convicted of rigging Libor. He says, I was just doing my job, and everybody who works in every bank PR department decides to put their head in their hands and give up, pretty much. So after that, Martin Wheatley, who's the head of the FCA at the time, was commissioned to do a very quick review of Libor. It had obviously already been on their radar for the reasons we've discussed, and he's supposed to say how we're going to reform this. There were a lot of results from the finding of the Wheatley review, but the main one is that Libor submission is now going to be overseen by the FCA. It's going to be regulated, and tampering with or falsely submitting a contribution to a benchmark, that's going to become an offence under FSMA, and you can get prosecuted and fined for it. At this point, banks are already very reluctant to carry on submitting Libor. They had, after all, only really been taking part in this process because they acknowledged it was necessary, the market needed a floating rate, and because they didn't think there were many consequences of it. As soon as they find out that they can get enormous fines, that their submitters and their traders can get arrested for tampering with it, they become extremely reluctant to carry on submissions. And the future of Libor looks, to be honest, in a bit of danger then. They only really carry on because the FCA cajoles them into it and says, no, come on, please, we need you to keep submitting it. We will view you as being cooperative if you keep submitting this benchmark. Now, that's important because in the first instance, our announcement in August that the FCA doesn't want Libor to continue is not an announcement that says you must not put Libor into loan documentation, you must not submit Libor. It is just them saying we will no longer encourage banks to submit estimates for Libor. In light of the fact that they're already doing this sort of, well, not under duress, but fairly reluctantly, what that means is that we will probably, unless another incentive is introduced, we will probably be seeing voluntarily these submissions start to go away. The final nail in the coffin that really prompted the FCA to say we don't want this to carry on was a review they conducted in the first half of this year. And the findings of that review were that essentially the market underpinning Libor, the interbank lending market, was nowhere near as deep or as broad as had been assumed up to that point. In some currencies and for some maturities, you had treasurers submitting estimates for their cost of funding where the number of transactions per year was less than 20, and yet they're submitting them every day. So this raises the question of, even if you have the most honest organizations in the world, how are they submitting this estimate for a market that just doesn't exist? And the result is sort of expert judgment, which one can believe, but there's a stretch to that. Our quote from Andrew Bailey is, how can even the best benchmark measure a market that doesn't exist? So that is the news that we will be finishing with this benchmark in 2021, and this creates huge sort of questions for borrowers and for derivatives market participants over what comes next. I'm going to talk about a couple of candidates for what might replace Libor in a couple of different currencies, but I think it's first worth going over what the sort of cliff edge scenario is. Let's suppose it's 2021, Libor has stopped, and you still have all of these loans and all of these derivatives that reference it. The main lack of availability clause in most of this documentation provides for the Libor screen rate being unavailable. And what that looks like varies depending on, I don't know, what facilities agreement, what offering memorandum, what ISDA agreement you've got in place. But broadly speaking, what it says is that you take the agent who's arranged financing, they will go out to a reference group of banks, commonly 3 or 4 banks. They will pick them. They might be involved in the financing. They will take estimates for the cost of funds at the start of each interest period. They'll average them, and that's going to be the floating rate. Now, this all sounds quite familiar. This is actually a reversion to what Libor looked like in the 70s. And it means that we don't fall off a cliff edge. We still have loans and derivatives that are based on a group of banks' estimated cost of funding. But it's clearly unsatisfactory because it doesn't address the questions of, are these transactions taking place? Or is it a valid estimate? Are people staying honest? Are they submitting actual quotes? And do we have any visibility over what's being submitted? basically just takes LIBOR as it is and puts it back behind the curtain. So it's not necessarily a desirable outcome for market participants, and it's not a desirable outcome for banks submitting it either, because it essentially impinges on this trust relationship they have with their clients. Two of the candidates, therefore, for replacing LIBOR have been talked about quite strongly. Now, in the main markets where it holds sway, the US and the UK, dollar and GBP LIBOR, we have two ready ones. Here at home for me in the UK, we have SONIA, the Sterling Overnight Index Average. Now, SONIA is already published, and it is a weighted average every night of all unsecured sterling transactions that take place in a reasonable size. That's over 25 million. It's measured between midnight and 3:15, and it's already published every day. The fact that it's already published obviously provides for a market to be made, and there is already a reasonable market in SONIA derivatives. What many of us use as a risk-free rate now are OIS rates, which are swaps on SONIA. So that already exists, but there are several key differences with LIBOR. The good one, the main one, is its actual transaction-based data. Very difficult to manipulate SONIA, and very difficult to say that it's not actually representative, because it is clearly taken as the average of transactions. The other main difference between LIBOR and SONIA, which we'll come back to though, is that it is only an overnight rate. You don't have any term structure. You don't have any idea of what the difference between 1 day, 1 week, 1 month, 3-month borrowing is for SONIA. You, of course, have swaps on it, but that's a different question. Over in the US, the broad Treasury refinancing rate is the main one that they're considering as a replacement, and a Fed-sponsored group, the ARRC, that's the Alternative Reference Rate Committee, they are going to start publishing this in the first half of 2018. Now, this rate is similar-ish to SONIA. It's an overnight rate. It's representative of transactions that have actually taken place, but the key difference is that it's the cost of overnight loans that use US government debt as collateral. It's based on repos. As such, it is not an unsecured rate. It's a secured rate. The other good news is that it has a 660 billion volume market pretty much on a daily basis, so again, no one can question that it's valid. Looking at those two definitions of SONIA and the BFTR, we already have a sort of interesting question, which is, how do we deal with this disparity between secured and unsecured rates? If we want a risk-free rate, clearly securing borrowing overnight with US government debt is, probably as close as you're going to get to a risk-free rate, so that's clearly good. But current LIBOR and indeed SONIA are based on unsecured transactions, so you have this sort of disconnect between the US and UK markets, and that leads people to be not uncomfortable, but to wonder whether there might be sort of arbitrage possibilities in borrowing. One thing that we see, one would imagine no, if one thinks of efficient markets and the fact that people will trade away those opportunities, but to look at a parallel situation, something we see a lot of people doing at the moment, for example, if they want to borrow in euros, they face floors at 0% for euro borrowing, but they can borrow in, say, dollars or Canadian dollars or sterling. They will find it advantageous to borrow in a different currency, cross-currency swap over into the currency they need, and create some synthetic debt. Now, it is not a stretch to imagine that this sort of different secured versus unsecured floating rate market might provide for a similar opportunity, and that's something that people definitely need to look into. The other main, not problem, but thing to think about with these new rates is that of necessity, if they're going to be transaction-based, every proposition, certainly these two, are based on overnight rates only. Now that means not only do we lose, from a sort of theoretical perspective, not only do we lose the term structure, what the difference is for different borrowing maturities, it also creates a problem, particularly for smaller borrowers. Under current LIBOR arrangements, if I'm borrowing on a quarterly basis, I know at the start of each quarter what my interest payments are going to be at the end of it. Under an overnight rate, one would imagine you would take the average of each overnight rate for the period. But what that would mean is that you won't actually know, if I'm a corporate, what I'm paying for that interest period until the final fixing of the period. Now, this might not be a problem for larger organizations, particularly for sophisticated ones who can track where SONIA has fixed each night and work out roughly halfway through their interest period, well, it's going to be roughly this. But for smaller, less resourced, maybe less sophisticated borrowers, it does create a problem of how to predict what their interest rates are going to be. And there's not an obvious solution for that. One idea is to use existing markets that are swaps on SONIA or swaps on the BTFR, but that in itself would depend on there being a fairly broad market that has those swaps rather than the underlying rate as its own underlying. Now, as we know, a trading desk can put a price on anything, but again, that might be a sort of premium paid by less sophisticated, sort of less well-capitalized institutions for borrowing. So it's really not clear what's going to happen there and how we're going to cope with that, but it's something that people will be keeping an eye on. The final thing to talk about is how we're going to manage, and I'm over time, the final thing to talk about is how this transition is going to be managed. Now, Libor doesn't just underpin a massive market. It underpins a market that has lots of distinct areas. You have borrowing, you have all different kinds of derivatives, and you have people who use this as their risk-free rate. What that means is that any transition has to be quite integrated across the different organizations. We already have the LMA and ISDA collaborating and sort of trying to harmonize their approaches to changing documentation. But if people are going to continue to use interest rate hedges to hedge their floating rates, they need the way that their loan agreements and the way that their ISDA agreements change to be harmonized with each other, and they need a transition process for that. Apparently, this is why we've got our 4 years. We've got until 2021 for this to take place, but none of those arrangements are quite clear yet, and to sort of take transition arrangements in analogy with my home country, the UK's current negotiations of a transition arrangement, one might think that 4 years is not enough for something that is so complex, affects so many and so large of a market. So yeah, in summary, this is something we don't know much about yet. We don't know concretely what the replacement for Libor is going to be, but for every borrower, it's a sort of known risk for 4 years' time. So it's certainly something that people will be putting scrutiny over. That's all. Thank you.